All right. Hey, good afternoon, everybody. Thank you for joining me today. And I want to get started with our weekly mortgage market update. So if you're joining me on Zoom, feel free to post any questions you have on Zoom chat. If you're joining me on Facebook, then feel free to post any questions you have on Facebook chats. And I'll try and get to the Facebook ones. I don't see those as readily, but I do see the Zoom ones right away. So let's go ahead and get started. So first of all, let's do what we always do and talk about where the rate market is at. And let me get my handy dandy little pointer out here. So pointer and pointer. Love it. All right. So first we're going to talk about what we're going to cover. So we're going to cover rate update. We're going to talk about the Fannie Mae tax on refinances. I talked to you guys about that a week or two ago and want to catch you up on kind of where we went with that and what that really means going forward. We've got more jumbo products rolling out, so I want to share the good news about that. I want to cover the 2 likely reasons why these low rates will come to an end. This will not last forever, and I feel pretty good about these 2 things being one or both of the causes for the low rates coming to an end, and I'll give you my feel on how long I think that'll last. And then we'll talk about how inflation impacts interest rates, and we'll have a little time for Q&A at the end. So let's go ahead and dive right in. First of all, interest rates. Interest rates are still doing the same thing we've expected them to do, guys. We've been talking about this since back in March. We've seen this chart move up and down a lot. We're seeing rates at the best levels we've seen them in a really, really long time. There is still a good size spread between where rates are and where they should be, but we're in really good shape. We're seeing a lot more volatility right now. So I will say that the stability we saw overall is still there, but we're seeing bigger up and down swings. And I'll show you in a little bit the day-to-day swings that we're seeing. There's a lot more volatility right now than we've seen in quite some time. So just be aware of that fact, especially if you've got buyers that are in the market and they have questions about, hey, what's going on with rates and locking and that kind of thing. We're seeing more day-to-day adjustments right now than we've seen in a few months. I don't think that's changing the big picture of where the market is at right now, but we are seeing movements from day to day. The Fed continues to be the biggest buyer and will be so for the foreseeable future. My lock advice still has not changed. If you're purchasing, lock it when you got it. Like you don't have the ability to wait and hope that rates drop a little bit, because that short-term up and down is going to kill you when it comes to getting the rate you want versus having enough time to wait out those movements. You just don't have extra time when you're purchasing a home. So when you're refinancing a home, time is on your side. I'm encouraging my clients and continuing to encourage them. Let's get the process started. Let's get you in line because there's a pretty significant backlog. And then let's make sure that we get your loan closed and lock it at the time when we're finished, so that we're not having to worry about a long-term rate lock and the extra cost added to that. And you get the benefit if rates continue to drop. So my advice has not changed in that regard. Now, let's talk about the Fhfa tax on refinances. If you missed my meeting from, I think, 2 weeks ago, go back and check it out on YouTube, youtube.com/JohnLoanKing. If you have not subscribed, please subscribe. My kids now watch YouTube all the time, and they've told me, Dad, we thought you were cool until we realized that you only have 92 subscribers. And all the rest of the people we watch have thousands and hundreds of thousands, so I guess I'm not the cool dad anymore. So help me be a cool dad and subscribe to my YouTube channel. Aside from that, guys, Fannie Mae and Freddie Mac, who were overseen by the FHFA, they came out and made a mandate 2 weeks ago that said, we hereby decree that you have to pay a 0.5% fee, one-time fee, on all refinances because of an adverse market fee. They're worried about rates being bad or the market going bad and them losing money, but they're making more money now than they've ever made in history. They're just adding this because they realize that, hey, rates are so low, we can make some extra money. 93 now. Thank you, Randy, for making me number 93. Who wants to be number 94 in my subscribe to my YouTube channel? I'm taking bidders right now. You pay me. I'm not paying you. Okay, so, but Fannie Mae came out and they said, okay, we're going to charge this fee. Freddie Mac said the same thing. And then everybody got up in arms over in the industry and they said, oh my God, you can't do this to us. And so they came out in the middle of the week last week and said, fine, we will postpone it until December 1st. And everybody's super, super excited. But I don't know if it really wasn't the grand ploy in the first place. Because I talked to you about Mark Calabria, the guy who runs the FHFA, and the guys, you can't trust him as far as you can throw him. I'm very concerned about what his intentions are, and he's one of the 2 remaining posts in the federal government that does not answer to the President of the United States. And he basically has everybody happy with a 0.5% tax that he's adding to mortgages because he postponed it until December. And what's the one way to get something added where people are paying money, yet they're happy to be paying the money? By making the rollout sound so much worse. Everybody's up in arms, and now you're super happy that they postponed this tax. The truth is, it's going to start impacting people around the time of the election, and the election itself is going to have a high amount of volatility. So right now is really the last moment where I'm telling people, if you've been on the fence thinking about refinancing, you need to start the process today, because it is taking upwards of 60 days to get a loan through underwriting and ready to lock. And we want to lock you before the election, before this, because this 0.5% increase goes into effect for loans that Fannie Mae buys on December 1st, which means we have to close it by like November 20th, which means we got to lock it in October. So this is going to be added starting December 1st on any loans that we sell to Fannie Mae at that time. It's not for locks starting December 1st. It's going to be more like locks starting, late October. So if you or somebody you know is on the fence, had been thinking about refinancing their home, figured, hey, I got time to wait. My first warning shot about interest rates moving up is right here, because the FHFA has all, and this is only affecting refinances, but the FHFA has made it clear we're going to raise the cost of refinances, and we're going to make you be happy about it because we're giving you a little bit of extra time to plan for it. So I don't really think it's a win. I think we've been hoodwinked. We're still having to pay extra fees on refinances, and we just need to get people in now so that they can get that process moving forward. If you have a past client you haven't talked to recently, have the love it or list it conversation with them. If they love their house, they need to refinance it because rates are super low. If they don't love it, it is the time to list it so that they can find a new property and they can get great interest rates on that next property that they're buying. All right. Again, guys, if you have questions, feel free to post it. Otherwise, let's talk. Again, I talked last week about jumbo delegated. I want to remind you about this stuff because we're doing 15% down jumbo loans now, up to $1 million with a 740 FICO score. We can go down to a 700 FICO score as long as you have 20% down. You got to have a lot of money in reserves, but it's a great product. And the greatest thing is the lender that we just brought on board on Friday is one of our favorite jumbo lenders. The investor's name is Redwood Trust. And I want to explain why Redwood Trust is such a big deal. So before I do that, I want to give you a big picture overview again of jumbo, because now that we're getting more jumbo options back, you got to be real careful about who you're talking to about jumbo and what information you're getting. A jumbo loan is anything greater than the conventional limit in that county. So 510,400 is the national limit for conventional loans across the country. But different counties can potentially go higher. San Joaquin County cannot, but Sacramento County can. It's $568,000 or $569,000 that you can go for a conventional loan. But anything above those numbers is on a loan amount is considered jumbo. The Bay Area, we can go up to, I think, $765,000 as a conventional loan. Anything above that is a jumbo loan. Jumbo loans are 100% the funds of that specific lender. It is not coming from a centralized source. It's not coming through Fannie Mae or Freddie Mac. It's not coming through me. So you've got to realize, are you talking to the bank that is giving the money, which in one way is a good thing. You can call the big banks, call Wells Fargo, call Bank of America, call Chase. They do jumbo loans, but you're only getting their set of guidelines. And the problem is they only have one tool. And when you have only a hammer, everything you look at looks like a nail, right? So they only have one product and they try and fit everybody in that box. And if you don't fit that box, they're going to tell you, I'm sorry, you're not qualified. Come back next year when you've met these new qualifications. But with Summit Funding, we now have 4 different jumbo investors. Now, mind you, pre-COVID, I had 12. So I went from 12 to 0. We celebrated a month ago. We went to 1, and then 2, and now we're at 4. So we're growing, and those options are coming back. But unless you are talking to the bank that's issuing the money, which again, I don't think is a great thing, because you only have their product and they're very, very narrow in what they offer. Otherwise, you're talking to somebody like Summit Funding, where we are not brokering the loan, but we are underwriting, we're funding the loan in-house, and then we're selling it to that designated investor after closing. The key is who underwrites the loan. And that's this word delegated versus non-delegated. So if you are in a jumbo transaction, whether you are the buyer's agent or the listing agent or the borrower, ask your lender, is the money coming from your bank? If the answer is yes, in a way, that's good because they control everything. In a way, that's bad because if something goes wrong, that's the only option they have. You also need to ask them, if you are not the bank that is sourcing this money, that is actually the provider of the funds, then are you delegated or non-delegated in your approval process? Delegated means they trust the originating bank to underwrite the loan. Non-delegated means the loan has to be sent to that other lender for a full underwrite, and often the appraisal has to be sent there as well. The first 3 banks that we brought back on board, we were non-delegated. I closed a $1.2 million property last month in San Jose, and I did it as a non-delegated loan. It was a little more challenging than I would have liked because I didn't have control over the turn times. We were shipping the file off to the underwriters at that other company. Redwood Trust, we are fully delegated. That means that we have the ability to underwrite the loan in-house. It's my company's employees who are underwriting the loan. We control the turn times. We control the communication. That is, to me, the best of both worlds because I have 4 different options to choose from. If something goes wrong, I can go a different direction, but I have an option that is in-house completely where we are underwriting everything in-house, and we have great success with Redwood Trust, a great relationship with them, and so we're quickly moving those loans through and being able to take great care of those buyers. They are doing a 15% down payment option as well. Again, up to $1 million. The rates, I shared a little bit more. Hold on one second here. So here's where we're at with interest rates. On a 20% down jumbo loan, I want to compare our Redwood Trust product compared to Chase. Now we do Chase's loans. Like I will, Chase is one of our investors. We can sell loans to Chase. With a 20% down payment and an 800 FICO score, Redwood Trust says, I'll charge you a 3% interest rate if you pay just a smidge more than 1.1%. Chase says, yeah, for a 3% interest rate, you're going to have to pay me 2 points. Guys, this is a loan that's $600,000 or more. That extra point is an extra $6,000 or more in one-time fee to get the exact same 3% 30-year fixed interest rate from Chase compared with from Redwood Trust. It is a very, very good product, and I am super, super excited to have it. But don't misunderstand. This is a lesson, by the way, in marketing, because you'll hear me say, by the way, there's no mortgage insurance when you're putting less than 20% down on a jumbo loan. That is a true statement, but it's smoke and mirrors because you notice we're at a 3% interest rate charging 1 point if you're putting 20% down. If you're putting 15, I mistakenly didn't change this. If you're putting 15% down, you're looking at a 3.5% interest rate to pay 1 point. It is, or almost 2 points to be at a 3% interest rate. In other words, guys, there is no such thing as a free lunch. When you have mortgage insurance needed because you're putting less than 20% down and a bank says, nah, we don't charge mortgage insurance, no problem. But they're making it up somewhere else. And where they're making it up is either in the interest rate or in the fee that you pay to get that rate. So just be aware, again, I apologize, I didn't change this slide title, but this is the 15% down payment option. And with 15% down, you have about a 0.5% higher interest rate. Still good interest rates, but it could be upwards of a 0.5% higher for the benefit of no mortgage insurance. And you do not have the option of having mortgage insurance. Like jumbo loans just don't do it. They just charge you a higher interest rate for that fact. All right. So moving on, if you guys have questions, again, feel free to post them. Otherwise, what I want to talk about is what you came here for, the question of when are low rates going to come to an end? There are 2 likely causes of rates changing direction. Again, right now they're in a downward trajectory, but the 2 things are positive news about the virus and inflation. Now let's think about this for a second. I'll break those 2 down. Positive news about the virus. Guys, when did rates start really dropping? Like really, really, really dropping? In March. What happened in March? All the bad news about the virus happened. The lockdowns happened, the economic slowdown happened, the recession happened. All of these bad things happened when all the negative news about the virus started. So what do you think is going to happen if, and well, not if, but at some point in the future when that news about the virus changes? As soon as that news about the virus changes, if we've got good drugs, we've got good numbers as far as the number of people that are being infected and ways to keep, get kids back to school, get companies back open. When that happens, all of this turns around. All of the, and I'm talking not about the housing market. The housing market's something totally different, but interest rates will start going back up because the economy is going to start doing good. The Fed is not going to be holding rates down in order to spur on the economy. They're going to allow rates to rise, and it's going to be great news for the stock market. There'll be a great run up in the stock market, and investors are going to pull money out of bonds to put them into the stock market. And guys, this is supply and demand. We need money every day. As lenders, we have to continue. It's like crack cocaine to us, right? I got to have my fix. I got to have more money coming into the industry so that we can lend it out. And that money coming in, if there aren't as many people willing to throw money at us, we've got to raise the interest rate to make it more appealing to get more people to want to invest in mortgages, to make Wall Street willing to invest in us. So positive news about the virus is a very, very big concern. I'd love for this to be the reason why rates go up. I'd love tomorrow for there to be positive news about the virus, but understand that is the first thing that is going to cause interest rates to turn on a dime. The second thing is inflation. Before I get into inflation, I want to, well, actually, I'll cover inflation first, and I'll talk about kind of my thoughts on the housing market. So first of all, what is inflation? Inflation is a general increase in prices and a fall in the purchasing value of money. And I'm gonna give you a simple explanation or a simple example, and that's the price of a movie ticket. So the price of a movie ticket in 1980 was $2.89. So if you had $10 in 1980, you could buy 3 movie tickets. In 2019, the price of a movie ticket was $9.16. If you had $10 in 2019, you can buy 1 movie ticket. That is a decrease in 2 movie tickets that you could have been able to purchase. And in 2020, what's a movie theater? You can't buy any movie tickets today. So maybe it's too soon for that joke. But anyway, the fact is that inflation, overly simplified, is the decrease in the value of, increase in prices and a decrease in how the purchasing value of your money. So is it good or is it bad? Well, here's the deal. Inflation spurs spending now. So if inflation goes up, the economy is doing good. Therefore, people are going to want to spend money now because they're afraid, oh my gosh, if I'm going to buy a car, I better buy it now. Because if inflation is going up, they're going to buy a car right now because they're afraid that a year from now that car is going to cost $10,000 more or $2,000 more. So it's going to make people want to buy more. If people don't want to buy, the Fed is trying to keep inflation low and keep rates low because they want to give people a reason to buy. But if people are already buying a lot of goods, that is causing inflation to go up because of, again, supply and demand. If the economy is doing well and everybody wants to buy, we see it right now in the housing market, don't we? Everybody wants to buy a house and there aren't enough houses for sale. Therefore, the price of houses go up. When everybody wants to buy a car, the prices of cars will go up. When nobody wants to buy a car, the prices of the cars will go down. That's called deflation, obviously the opposite of inflation. But so again, is it good or is it bad? It's bad. It's good because it keeps people buying now and it gets people to go out and buy. It's bad because it costs more to buy stuff. So your dollar doesn't go as far. The good news, it pushes employers to increase wages. So sooner or later, like guys, you can complain about a movie ticket being $10 now instead of $3 40 years ago, but you're making way more money now than you were 40 years ago. So you've got to take the good with the bad. Inflation is going to mean an increase in your wages as well. So it's not necessarily a bad thing. Inflation itself is healthy. Okay, inflation is healthy. But here's the other side. Inflation causes mortgage rates to go up because a mortgage is a fixed amount of income that a bank is going to earn. We know that on this 30-year fixed rate loan, every year we're going to make X number of dollars in interest income on that loan. And if inflation skyrockets, then those dollars that we have for the next 30 years won't be buying as much for us 30 years from now when we receive the last payment. Therefore, we will, as an industry, raise interest rates, because Wall Street, the investors that we have to keep feeding our machine, are saying, nope, I don't want to buy mortgages, because sooner or later I'm going to lose money, because because inflation's going to go up so much that that dollar I earn on that mortgage isn't going to be worth the risk I took. And the only way we offset that is if we raise interest rates on mortgages, not after inflation's happened, but in anticipation of inflation. That's the key. In anticipation of inflation, interest rates will start going up. Why is this a big deal today? Because the Fed changed their tune a few weeks ago, and they had a meeting last Thursday, and they talked about it again. And they made it clear they changed their target from a 2% maximum inflation rate to a 2% average inflation rate. That means right now, last month we were at 1.3% inflation. Prices rose by 1.3% year over year in the report they pulled last month. And the Fed says in the past, we'd let that go as high as 2%. Well, that means it could go only up by 0.7% more. But now they're saying, well, no, I want an average of 2%. That means that up until last month, inflation was at or below 1% increase, meaning that prices were increasing by less than 1%. How do you average 2% when for a long time we've been at 1%? By letting inflation go to 3% increases. That's triple the amount of inflation that we have historically had. Now, I don't think it's going to go there anytime soon, but it is scaring the market a lot. So I'm going to show you a couple of screens here. This is last week on Monday. This is the movement inside of a day of where rates move up and down in a day. Okay, nothing, you don't have anything to compare this to. What I want to point out is it goes from 105.16 down to 104.9. So basically like a 20.25%. That's a 0.25% change in fee. Now remember, everybody's freaking out about Fannie Mae charging an extra 0.5% in fee. Last Monday, rates moved by a 0.25% in fee during the day, just up a little, down a little, up a little, down a little. But the highs were a 0.25% cheaper in fee than the lows. But that's normal. Now let's look at last week on Thursday. This is the day the Fed talked about their change in inflation. What we saw was the highs being 105.25 and the lows being 104.75. We had a 0.5% variation, and it wasn't just a little bit of a movement. It was pretty psychotic. The market was up and it was down. Every time there's more than a 0.25% movement, I get one of these alerts. We got alerts over and over and over again because the market did not know how to react to the Fed. Friday, same thing. We went from 105.4 down to 104.9, a 0.5% swing in fee between 7:30 a.m. on Friday and 12:30 p.m. on Friday afternoon. So huge variation in fee in the middle of a day. This is the volatility I'm talking about from day to day. Now we fast forward to today. Same thing. We start out at 105.04. We go up by a 0.25%. That's good. Up is good. It means we save clients fees. We save clients a 0.25% in fee. Remember, everybody's up in arms about a 0.5% in fee that Fannie Mae and Freddie Mac are charging on refinances. Guys, in the middle of the day, we're moving by more than that amount on wild days. So we went up, immediately come back down. We're bouncing up and down. Again, we touch as low as 104.95, and then we're back up and we end the day at the peak. All I'm trying to show you is this inflation fear is real. And I don't expect, first of all, these numbers come out once a month. If next month comes out at 1.5 or 1.6, the market's going to do a lot more concern. So the end of September, we got to pay attention to the inflation numbers. If at the end of October, they're coming out even higher, now we really got to start worrying. So right now I'm saying short term, we're good until late October on interest rates. But there's a lot of unknowns that are going to happen between now and late October that can specifically change the outlook on interest rates, including the election itself can make a really big impact on the outlook on interest rates. All right, so that's enough about interest rates, inflation, all that kind of stuff. Quick bonus for today. News came out last week. We can do down payment assistance loans now down to 620. Pre-COVID, I could go to 600. It immediately shot up to 660. Then it went down to a 640. Now we're back down to a 620 for down payment assistance. So really, really good news there. The other thing I want to quickly share with you guys is the housing market itself. Like everybody's worried about, oh my gosh, John, you're talking about rates going up. What's that going to do to the housing market? Nothing different than what the increase in housing prices is doing to the housing market. You guys are dealing with this every single day right now, where you have a buyer that purchased a home today that bought it for $20,000 more than somebody bought the same home for 3 months ago. Like, it's happening. People are writing price offers for prices above that. They're making higher monthly payments because of it. They are not deterred. There are other factors driving people's desire to become homeowners. It is not about the interest rate. That's just one part of it. But when prices go up on homes, they have to pay more. When interest rates go up, they have to pay more. It's just another increase in the monthly payment. I'm not saying that's okay, but I'm saying that nobody's freaking out that buyers are going to stop buying because prices have gone up. At higher prices, buyers are still buying. At higher interest rates, buyers will still buy. So you don't freak out about that, because interest rates are a bonus. We rarely have an environment where we have super low interest rates and a super strong housing market. Those typically work opposite of one another. So we are being spoiled right now. And in my industry, we got the triple threat, because now we got all the refinances going on right now too. So we're totally being spoiled. But the fact is, I am not worried about the housing market. Everything that I read, everything that I see says we've got a strong housing market going through 2025 to 2026. We've got a lot of 30-somethings that are out in the market in real serious droves trying to buy homes when they had spent the last 10 years living on their parents' couch. First-time home buyer numbers, 2 years ago, 26% of buyers were first-time home buyers. Right now, 35% of buyers are first-time home buyers. Significant increase in the number of first-time home buyers that are out there. You guys know this better than I do about what's going on in the market, who your buyers are, and what they're doing. So do not let the concern about interest rates going up freak you out about the housing market. But if you or anyone you know was thinking about refinancing and thinking, I got a lot of time, it's no big deal, you're on borrowed time. Now, it might not end in November. It might last another year or 2 or 3 years. I don't know. But the concerns that I'm bringing up are real. If inflation starts going up a lot, rates will rise. Once we get a strong positive news on this virus and we get it under control, rates will rise. I can't promise you when those things are going to happen, but pay attention to it and keep your eye on the ball to make sure you're giving the best advice you can. And speaking of great advice, don't forget about me. When your buyers are looking for great advice, I'd love the opportunity to help them out. So guys, it is 3:29. If you have any questions, feel free to post them into chat. Otherwise, I'm going to let you guys go. Have an absolutely amazing day. Can you believe it's the end of August? So we got 4 months left in 2020. Then we start over with a new year and hopefully a much, much better year than the one that we have right now. So thanks everybody for joining me. Have a great week, and we'll talk to y'all soon. Bye-bye.